Hi guys, welcome back. So today I think everybody's account should be green after so many days of torturing. The market is doing its own thing and it's impossible to time and neither to explain what's happening sometimes. Nasdaq, it's up 1.1%. What's stronger today was the Russell 2000, which totally looked like it was breaking the support yesterday and yet came back up strong. In the morning, it opened quite low and kept going down. So for a lot of stocks, you can definitely see some panic selling in the morning. Maybe instead of panic, it should be more like couldn't take it anymore. And then right away, it bounced back up strong. But we do need to watch out for the volume. Today, it went up more than it dropped yesterday, and yet the volume is smaller than yesterday. So gotta watch out for this. See if it's a real reversal. The support previously was 219, and if it can successfully stay above this support within the next few days, that would make yesterday and this morning a wash sell to shake out the people. The PGJ China ETF was bouncing off the support. As I said for a few days already, I expect this support to give it a little rebound. See if it can break through this triangle for now. Let's see if it can break through this triangle for now. Now the 250 moving average is getting close. We can also take a little bit of consolidation, take a break, and then backtest the 250 moving average. That might make it a healthier run. Let's see. This is the CQQQ. This is an ETF for the China big tech, like Tencent, Meituan, Baidu, etc. Okay? Kind of like the QQQ for Nasdaq, but except it's for China. We can see this run up to mid-February and a big fall. And right now it has found support and continue to make higher high on the uptrend. Back testing for a few times. Zoom in a little bit more. See, it's making higher high every time. So technical wise, it doesn't look bad. Looks like it needs to rebound. And if so, then we can think about how to adjust our portfolio. Now, last night, the Hang Seng Index had a little bit of a correction. You see that it had a gap down below, looking like it was going to break the 20-day moving average and then bounce back up and got supported. So, looks like it's a false alarm. Plus, it was dropping with little volume. So overall, looks like a back test, a little bit correction, more than the possibility of going back down. But overall, the small caps generally gave a good rebound today. So a lot of us might be wondering, thinking whether this is a reversal or just a bull trap. Whether you can chase right now or start averaging down, or should you wait for a pullback? Let's see. I think everybody wants to know this. I wish I knew too. But I'm gonna give a little analysis anyways, so if I'm wrong, don't blame me. So I do think the big caps have been growing for a while. Like for example, Amazon had been growing for a few weeks already. And Facebook too, you see that it has gone up for a while, few weeks, from the lowest of 253 to the highest of 315. So for a mega cap, that's quite a big run up. So I think it does need to have a little bit of resting. So you see this week it has been pulling back testing the support of the previous high. During this run up, I guess a lot of retail investors wanted to cut loss on their small caps and chase the mega cap, telling themselves, yeah, it's better to buy the big caps anyways, because the small caps just keep falling. And the moment people cut loss on the small caps, this is when the big caps need to rest again. Sectors rotate quite often, faster than we expected. That's usually how it goes. So I think the FANG stocks, the mega cap stocks, are taking a moment to breathe. So meanwhile, the Nasdaq can take a little moment to rest a little bit, gain some momentum, consolidate, and let the other sector, the small caps, move a little bit. So the Russell 2000 has been consolidating for a while now. And I do expect it to stay back above the 60-day moving average. So we need to jump back up again, up the stage to consolidate and eventually break through, while the Nasdaq can take a break. But I also think the small caps would rotate as well. If we take a look at today's winner, maybe we can analyze this by the stocks today. Today's winner is obviously SKLZ. Had a great run up of 33%. How come it can have such a big run up today? Well, because most people already sold within these few days of going down a little bit every day and then a final shake of yesterday, right? So less retail investors holding it means easier to pull it up because there is less selling pressure within this range because a lot of people sold today already. And the people who bought here, they're not even at cost yet, so they may not want to sell yet. And if we look at the 5 minutes chart, you can see that in the morning, it opened low and continued driving down quickly. See if more people would lose it and sell out at the last moment, dipping to the low of 12.4, and then right away had a run up like this. This is giving chance for retail investors to sell, consolidating in this platform, because after dropping for a long period of time, giving you a little bit of hope and then go down much further. If anyone did not sell before, this might be a strong urge to sell here. And I think retail investors won't chase here yet. After the people who want to sell have already sold, then they did another pull up again, give you another challenge. Sell or not, sell or not. Then did another consolidation here to see if you are selling. So when it had run up around 6 to 10%, I don't think people would want to chase yet, but to keep seeing it rising from 10%, 12%, 15%, 20%, 25%, 30%, that gotta give people some more anxiety. I think the institutions know so many retail investors are traumatized by this falling every day that the FOMO is not building enough for most people to chase. But if given another green bar like this, let's say another 10%, then I think a lot of people can't take it and might start to chase. So I won't be surprised if it can get to this level, around 18 to 20 in the recent days. Then at that time, the people who bought in here, a trap here, might want to sell out because you can see a lot of people bought here. Between 17 to 20 here, these few days. And then it kept dropping, making everyone who bought here trapped. SKLZ has trapped a lot of retail investors. So don't be surprised if it has a pullback and takes some time to recover. And if you're looking to average down and it keep rising, it might not be a good idea to chase right away. But instead, when it does some pullback, back testing here or here, might be more safe to buy the dip. That is just my opinion. If you're a long-term investor, just forget about it and keep holding. Less transaction is always better. Let's look at another example. This is YSG. Today it grew 11.9%. At some point it was growing 15%. The reason was because the company published the year earning of 2020. Revenue of 5.2 billion yuan, year-over-year increase of 72%. Margin 3.3 billion, year-over-year increase 74%. And still net loss 2.6 billion yuan, while 2 billion would be the share incentive for the employees and partners. So if we don't consider that, the net loss is 780 million yuan. So is this really completely because of the earning that makes YSG rise? I don't think it's completely it, because we did see the Q4 earning, and we remember the Q4 earning did not give it such a good run up, and it was crashing right after the earning, actually. And once we had the Q4 earning, it wouldn't be hard to know the whole year of earning anymore if you combine the 3 quarters previously. So earning is really up to interpretation. But here we can use the number to calculate a little bit of the PS ratio. So 5.23 billion divided by the conversion rate of 6.5 would be 0.8 billion US dollar of annual sales. And if we use the market cap right now of 6.9 billion dollar, so 6.9 billion divided by 0.8 is equivalent to 8.6 PS ratio for YSG. And if we use the closing price of yesterday, it would be equivalent to 6.1 billion market cap, divide by 0.8 billion of sales, that would make YSG's PS ratio of 7. So yeah, I think that's the real reason why it's rising, because the PS ratio is quite low, it's quite reasonable. Especially the makeup industry is quite fast growing in China, and the margin for cosmetic is quite high. It could be anywhere between 70% to 90% even. And for YSG is already good enough. Right now, YSG's margin is at 64%, which is pretty good considering their positioning is to provide affordable cosmetic for young women. So 64% of margin is not bad. So the margin level is close to SaaS company. So SaaS companies usually have the highest margin because software developed to provide to clients, and it could be duplicated as much as they want and still can charge the same amount. So that's why they usually have high margin, and also the reason why they usually can get a high valuation, a high PS ratio. Could be anywhere from 15 to 100. If YSG can get a PS ratio of 15, it would mean the price can double from here. But right now, everybody is concerned about their marketing costs, which is pretty high. But I can understand, because as a Chinese makeup brand, the biggest barrier is how Chinese people look at Chinese brands, especially for cosmetic. This issue is quite similar with NIO, as people have the same perception of Chinese cars to be cheap, low quality, and a bad brand. So increasing their marketing budget at the beginning, it's quite necessary, in my opinion, to improve the brand image of Chinese brands, Chinese cosmetics, Chinese cars. So young people can actually start to feel proud to own these Chinese brands. So that's why I agree with the high marketing budget, especially at the beginning, to open up the market, to change the perception first. Another concern of investors would be the product quality and the innovation. First of all, I think their product quality is okay, given the fact that they are basically using the manufacturers that's the same supplying to big brands like Dior and many famous brands. But this year, we do see that they are increasing their R&D costs, so that might be a good sign. We'll see. So I think it's really up to interpretation for people to digest the earning. So I wouldn't trust the price movement against the earning completely, but really to look at the company from our original perspective and less driven by the price action. Actually, you know what? The video is getting too long, so I'm gonna share this part tomorrow. So you have to come back and watch the second part of the video. Now, if you have enjoyed this video, please give me a big like and write me a great comment. And I'll see you tomorrow. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.